Good afternoon, my people. What is going on? It is your main man, Charles Pank Harris, the founder and chief visionary officer of the financial literacy platform Wealth Our Way, where our motto is wealth is not only for the wealthy. I want to welcome each and every one of you to a brand new week here at Wealth Our Way. And we are in episode 123 on 15 Minutes of Finance, kicking off Student Loan Week. Before I get into all of that, though, you know I got to practice the attitude of gratitude and say thank you to each and every one of you who are here with me live as I stream across the Wealth Our Way Facebook and YouTube pages. I also want to give that Wealth Our Way Nation salute to the many members of Wild Nation who watch this program pre-recorded overnight, over the weekend, or wherever you can squeeze 15 minutes of financial literacy in. And then last but not least, a heartfelt how are you to the good folks on the Life 101 platform who listen to the audio recording of this very here program. So for those of you who have been rocking with us from the very beginning, and those of you who come on board midstream, you know this is a work in progress. And one of the things that I am striving for every day, as you see that I'm changing up logos, changing up formats, what I'm trying to do is give you the best viewing experience to show the appreciation for the 15 minutes that you commit to this program. With that in mind, I was talking to staff earlier today about how we want to improve upon the program. And what I decided is I'm going to use Tuesday to not only introduce what we're talking about for the theme of the week, like this week at student loans, not only introduce the guest that we're going to have on tomorrow night for the Financial Power Hour, but to also give a market recap and financial forecast outlook of the entire economy on Tuesdays. So what I'll do is on Monday, I'll go through all the numbers. I did that yesterday, and I'll come out here every Tuesday and talk to you about how the stock market's doing, how the cryptocurrency market is doing, what's going on with inflation, answer any questions or concerns that you guys and girls may have. And then we'll get into what we're talking about this week, introduce the guests, and we'll be out. 15 minutes doesn't go very far these days. So with that being said, the real catalyst behind that change is, as you guys know, I tell you over and over again, I just don't come out here and talk to you guys about finances. I run a financial planning firm and I have clients, and my clients almost across the board are freaking out right now by the market, what's going on in the market. And just as a reminder, when you hear the term the market, people are normally referring to the S&P 500. Sometimes they're also referring to the Dow Jones Industrial Average. And the S&P 500 are 500 of the largest companies in America. The Dow Jones Industrial Average are 30 companies that comprise the Dow Jones Industrial Average. What I want to say to you guys, and this is a shameless plug for my credibility, is I started talking in early 2021 about the impending financial downturn. And, you know, I got a lot of grief on Clubhouse and other places from people who just want to think this thing goes up and up and up and up. You can't understand economics if that's what you think happens. And I try to explain that to people, but I sound like the party pooper sometimes. As I explained, I had a very diverse academic experience at Temple University. I started off as an accounting major, switched to an actuarial science major, and graduated with a degree in finance. So I have studied statistics, I've studied economics, I've studied investments, I've studied debit and credit side accounting, anything that had to do with business for the most part, other than marketing and managing, I was studying that. The actuarial science time that I have was probably the most enjoyable, could have challenged my math brain. And I learned the power of the law of large numbers. That's what any statistician will tell you, that anything can happen 5 times. You can flip a coin, and we all know that a coin has 50% chance of ending up on a tails and 50% chance of ending up on a heads. But you could flip a coin 10 times and get 10 tails. That does not mean that the coin is broken and that it's 100% tails coin. It just means you haven't flipped it enough times to see what will happen over the long run. That is why there is such a thing called the law of large numbers. the more times you witness and experience something, the more predictable and true the outcome is. Why did I give you that little stat lesson? Because I want to talk about the stock market for a moment. The S&P 500 goes back over 100 years. Its inception is over 100 years of ups and downs. So I think that will give you a very good a very good large number. If you look at what historically the stock market has returned, and this is if you take all of the dividends that you get from your stocks, all of the short-term capital gains that get spit off, and you reinvest them into your portfolio. If you do that year in and year out, the S&P 500 historically returns around 10.2%. That's an average return year over year for over 100 years. That is something you can put your hat on and say, I expect the stock market to give me 10.2% a year. Well, let's take a look at what's going on right now. In the year 2022, this month, January, which is almost over, and I know a lot of you are saying, thank God it's almost over, the market is down 10%. Down 10%. That's in 1 month. And like I said, I got clients who have been calling me off the chain for the last week and a half, 2 weeks. I want to move all my money. This is killing me. I don't understand what's going on. And I tell them to relax and let's think law of large numbers. If you look at what the S&P 500 has done over the last 12 months, which is still not a large number, but it's a year. Over the last year, the stock market has returned 12.1%. Now, I just told you that we expect it to return around 10%, and instead it returned 12%. So if you got your thinking cap on, the market has done better, 20% better over the last year than it historically does. Let's expand that number out even further, because the more we expand it out, the more predictability it will show us. Over the last 5 years, the S&P 500 has averaged 17.66% a year. 17.66. Now, once again, I hope you are staying with me. I know numbers make some people's eyes glass over. If we historically expect it to do 10%, but we've been watching it do 17%, you can be one of those overly optimistic drunk people who think, oh, it's a new day. The market now returns 17%. Or you could be logical and say, we're in a good period. The market returns 10%. That's what we can count on. So if we know it returns 10 and it's been doing 17, what does it have to do to get back to 10? It's got to go down. And we see that time and time again. When it goes down more than 20%, we call it a correction. When that period lasts for more than 12 months, we call it a bear market. We see bear markets and corrections at the end of every economic cycle. We see 20% corrections. Hell, in the decade of the 90s, now I'm going to date myself, from 1990 to 2000, the market didn't return anything for 10 years. They call it the lost decade. When you average all 10 years return, it basically averaged out to be zero for a whole decade. But then we had decades where we did 18% instead of 10. The reality is that the market will always go up and down. Here's why this is important. Because I'm a financial planner, and one of the very first things I do with new clients is talk to them about what their risk tolerance is. And there is a big difference between you telling me what your risk tolerance is when we are on a virtual meeting or sitting in an office and you haven't put any money in play. And then a whole different risk tolerance when you're watching your life savings or your retirement money go down 30%. All of a sudden, now what was in theory is in practice, and you're not the same person. Little side note, everybody knows I used to play cards professionally, blackjack in particular. I play blackjack with $5 on the table the same way I play it if there's $5,000 on the table. Some of you guys who are watching this have been to Vegas with me and know me from my travels. I have had hands of blackjack where there was $25,000 being wagered. I put $5,000 up, got a couple of splits and double downs. And next thing I know, the hand is 25 grand. That's more than some people bring home after taxes for the year. And I play it the exact same way I would if I was at a $5 table and it was $25, because the rules are the rules. The situation does not dictate the rules. The rules are the rules. If you have a pair of 8s and the dealer has a 7, you split. You don't not split because that's a lot of money out there. No, you split because that's what you do. It's the same thing when we're talking about risk tolerance. Your risk tolerance that we come up with will tell you how to invest your money. And if you invest $5 or $5 million, you have to keep the same discipline or you're going to harm yourself. Everybody who's calling me right now and I have to talk them off the ledge and they want to take their money out, you're going to miss the return of the market, the rebound. There's an old saying, it's not timing the market, it's time in the market. The best investors, the best people who do the best in their investments are people who never open their damn statements. They have a dollar cost average plan. They have a good asset allocation. They have money going in that they can afford to be apart from, and they wait. And if they do that, when that person opens their statement 24 years from now in retirement, they're going to have more money than the person who opened their statement every month, watched MSNBC every day, and thinks that they're smart enough to figure this whole thing out. You're not. I'm going to be cocky right now. I'm probably smarter than you. I am one of the smartest people that I know. And I'm telling you, this is proven. WISCAR tests, being an actuarial science candidate, all of that stuff. I'm pretty bright. And I can't figure out how to beat the market. It cannot be done. I stand by that statement. However, there is a whole industry of people who make a very good living convincing you that it can be done and telling you they're going to show you how. It can't be done. Put your money into these investments and wait for them to grow. That's it. The rest of finances is about budgeting. It's about debt reduction. It's about best use of a dollar. It's about the things we teach here. It's boring, but it makes you a millionaire. That's what the best people do. So while we have a few minutes left, I talked about the S&P 500. If you think the S&P 500 is making people's stomach hurt right now, the cryptocurrency market is really making people's stomach hurt. So I'm going to tell you about Bitcoin, because I'm not going to talk about the other 4 that I hold, because I don't promote you guys going out and buying Bitcoin, buying cryptocurrencies that you don't understand. But Bitcoin, let's just talk Bitcoin for a minute. As of yesterday, Bitcoin was trading at $33,648 US. Just 2 months ago, on November 10th, it had hit an all-time high of $68,789. That means that in order for Bitcoin to just go back to the high that it has already established, it has to return 105%. So the question becomes, do you think Bitcoin was a fad, or do you think it's going to be around for a while? And if you think it's going to be around for a while, do you think it'll ever get back to where it once was? I think the answer is yes. So you are now looking at 104% return if you put your money in today to when it gets back to that high. Now, I can't tell you how long that's going to take. It could come back up in 3 months. It could come back up in 6 years. But 6 goes into 104%, 17% a year. 17% return is a great return. So my thing is, stop worrying about what's happening day in, day out. Buy low, sell high. So that's my market update. We are getting into student loans this week. We're going to talk about this Navient lawsuit and the bailout and the forgiveness. We're going to talk about the difference between subsidized loans, unsubsidized, private, federal. I'm going to have my guest, Dr. Jen Dobson of degreesofsuccessinfo.com on here. She's been on the program before. She is amazing. She's a wealth of knowledge when it comes to student loans. I am super geeked about having her on here and talking about student loans tomorrow for the Financial Power Hour at 6 p.m. tomorrow night. So look forward to that. Don't panic with your stocks and your cryptos. Buy more if you have cash. Dollar cost average increases are what you should be doing right now. And with that being said, I got to sign off the same way I always do. Wealth is not only for the wealthy. See you next time.